In 2026, the US government is stepping into the world of cryptocurrency like never before. New regulations, sweeping tax policies, and powerful enforcement measures are about to change the game for everyone. This isn't just about Bitcoin or it's about NFTs, every altcoin, and the very future of digital assets in America. Some investors see this as long overdue protection. Others see it as a direct threat to their freedom. But here's the unvarnished truth. Whether you're a casual trader, a crypto millionaire, or just someone holding a few coins in a wallet, these changes will directly impact your money, your freedom to trade, and your financial future. Tonight, we're breaking down exactly how these new US regulations will shape crypto in 2026, and what you absolutely need to know to survive and thrive. The crypto market's growth over the past decade has been nothing short of explosive. What started as a niche digital experiment, a curiosity for tech enthusiasts, has morphed into a global financial force. But with great power comes great scrutiny. In 2026, the US Treasury, the SEC, and the IRS are rolling out a coordinated set of policies. They're targeting everything: exchanges, stablecoins, DeFi platforms, and even individual wallets. On one hand, many of these rules are designed to prevent the fraud and scams that have plagued the industry, aiming to protect everyday investors from losing their hard-earned money. But on the other hand, some of these policies are controversial. They raise serious questions about government control, financial privacy, and the fundamental principles of decentralization that made crypto so revolutionary in the first place. In this deep dive, we're going to explain the new rules, uncover the potential consequences, and outline the strategies every American crypto investor should be considering right now. For years, many Americans adopted a sort of don't ask, don't tell policy when it came to crypto taxes. Well, 2026 is the year that ends for good. The new regulations make capital gains reporting stricter and more comprehensive than ever before. Gone are the days of hoping small trades fly under the radar. Now, even minor transactions are subject to reporting requirements. The IRS isn't just asking for compliance, it's enforcing it. They've implemented sophistication, automated tracking systems that link directly with exchanges. This means that for the average investor, there's nowhere to hide. It brings transparency, but it also brings a massive new responsibility. For those who choose to ignore these new rules, the penalties are designed to be severe. Let's get practical. Imagine you bought a fraction of an altcoin and then traded it a month later for a small profit. Under the new system, that trade is automatically reported. We'll explore examples of the new reporting procedures, breaking down exactly how short-term versus long-term gains are taxed under this new framework. Most importantly, we'll show you how you can stay compliant with the IRS while still using smart legal strategies to protect your wealth. One of the biggest shifts is coming from the Securities and Exchange Commission, or the SEC. After years of ambiguity, the SEC has finally drawn a line in the sand, clarifying which digital tokens are considered securities. In simple terms, any token that functions like an investment contract where you invest money in a common enterprise with the expectation of profit from the efforts of others will now be regulated just like stocks. This has monumental implications for the market. It directly affects initial coin offerings, or ICOs, many DeFi projects, and a huge number of emerging exchanges are now legally required to delist any tokens that don't comply with these securities laws. This creates a huge risk for investors. If you're holding or trading these assets and ignore the regulations, you could wake up one day to find your tokens are worthless or untradeable on major US platforms. We'll look at real-world examples of tokens that have already been delisted and analyze how investors are impacted, offering lessons on how to spot these risks ahead of time. Next, let's talk about stablecoins. These digital dollars have become the backbone of the crypto economy, facilitating trillions of dollars in transactions. In 2026, regulators are clamping down hard. Issuers of stablecoins will now be required to maintain full, one-to-one reserves, undergo regular, rigorous audits, and comply with standards similar to traditional banking institutions. The goal is to prevent a catastrophic collapse like we've seen in the past, which is a good thing for stability. However, this also limits some of the flexibility and innovation that made stablecoins so attractive. We'll show you how these new rules will concretely affect your everyday use of stablecoins, from payments and remittances to crypto lending and earning yield. And that brings us to the Wild West of decentralized finance, or Platforms that offer lending, borrowing, and yield farming have operated in a gray area for years. That's over. Many DeFi projects will now face new oversight. They'll either need to register with regulatory bodies or partner with licensed financial entities. Unregulated platforms face the very real threat of shutdowns, massive fines, or even criminal charges for their operators. So, what does this mean for the ordinary American using DeFi to earn a better return on their savings? We'll analyze how you'll be affected, highlighting both the new opportunities that might arise from safer, regulated platforms and the risks you need to be aware of. The days of anonymously farming yield on unaudited protocols are numbered. This leads us to one of the most significant changes: privacy. Exchanges operating in the US now face much stricter Know Your Customer, or KYC, and anti-money laundering, or AML requirements. For all practical purposes, anonymous trading in the United States is gone. To use most major platforms, you will have to verify your identity, linking your real name and address to your crypto activities. This is a major blow to privacy-focused investors who valued crypto for its pseudonymity. There are pros and cons here. On one hand, it makes it much harder for criminals to use crypto for illicit activities. On the other, it gives the government an unprecedented level of surveillance over your financial life. We'll break down this trade-off and discuss strategies to remain compliant without completely sacrificing your personal and financial safety. Every investor will be affected differently by this new landscape. Long-term holders, the hodlers, may face increased reporting burdens but could see minimal impact on their core strategy if they're reholding established assets like Bitcoin. Day traders, however, will face a radically different environment. Reduced flexibility, higher compliance costs, and the end of anonymous trading will force them to completely rethink their approach. Even international investors who use US-based platforms will need to adjust to these new American rules. We'll provide practical, actionable steps you can take right now to protect your assets, legally minimize your tax burden, and ensure you stay on the right side of regulators. This isn't about finding loopholes. It's about smart, informed navigation. Make no mistake, 2026 is a pivotal turning point for cryptocurrency in the United States. These regulations are fundamentally reshaping the market. Some will see it as a necessary step toward maturity and mainstream adoption. Others will see it as an unacceptable restriction on financial freedom. But regardless of your perspective, the key to success is education and action. You need to understand these laws, adapt your investment strategies, and most importantly, don't panic. Crypto is not going away. It's here to stay. But in this new era, only those who navigate the regulatory landscape with knowledge and foresight will truly thrive. The future of digital finance is being written right now, and your next move will determine whether you prosper or get left behind. Thanks for watching. If you found this breakdown helpful, make sure to like this video, subscribe to the channel, and hit that notification bell so you don't miss our future updates on this rapidly evolving space. Stay informed and stay safe.